Hello, this is Joe Hoyle at the University of Richmond talking to you again about financial accounting. In this chapter, we are starting our first time looking at specific accounts. Previously, we have looked at financial statements and we've looked at the general nature of United States generally accepted accounting principles. Beginning with this chapter, we're going to look at specific accounts and what they mean. In this chapter, we're going to look at accounts receivable. Now, you know what an accounts receivable is. It is the amount that your customers owe to you. So if you look at a balance sheet and look at assets and find accounts receivable and it says $2 million, then we know that refers to the amounts that are owed by the customers to the company. Now, in this first video, your roommate says that her parents have started to sell their ice cream to various restaurants. In fact, it says that in this year they sold $300,000 on account to these customers, and the customers still owe $90,000. The roommate, though, is worried that they cannot collect all $90,000. In fact, a $2,000 account is already under some concern. How do you report that information? There's where financial accounting becomes very interesting. How do you report that level of uncertainty? The company has $90,000 in accounts receivable, but they will not collect the entire amount. What do they do? Well, the first thing you should know is that United States GAAP says that accounts receivable should be reported at what is called the net realizable value. And net realizable value is the estimated amount of cash that you can get. So if you have $90,000 in accounts receivable, but you believe you could only collect $84,000, then you should report $84,000 because that is the net realizable value of those receivables. The question that she poses, or that the roommate poses, is how do you do all of this stuff? Well, clearly, if you're going to report your accounts receivable, you have to make an estimation of the amount that you can collect. This is where the accountant goes back and looks at previous years, looks at that historical data, and attempts to come to some guess, some educated guess perhaps, of the amount that they can collect. And this chapter talks a lot about using the percentage of sales method or the percentage of receivables method to make that estimation. So in this case, let's assume, for example, that we believe that they can collect $85,000. They can't collect all $90,000. How do you recognize that $5,000? Well, at this point, the matching principle that really is an essential part of accounting, a component of accrual accounting, becomes important. If you don't believe that you can collect $5,000, but you don't know that for certain, when do you recognize the $5,000? Well, you know from earlier in this book that the matching principle says that all expenses should be matched with the revenues they help to generate. So therefore, if you recognize the revenue in this year, you have to make an estimation of the amount that will prove to be uncollectible and recognize it in the same year. But since you're recognizing it in the period when you make the sale, you're having to do that based on a guess. As we've talked earlier, that's why we stay away from the terms exact and correct, because they imply facts. Things like net realizable value are estimations. Now, we hope we can make good estimations, but they are just estimations. So when the accountant comes to the end of the year and the company says we have $90,000 in accounts receivable, but we can only collect $85,000, the accountant has to make an adjusting entry to recognize that $5,000 estimated bad account. So you would debit or increase bad debt expense by $5,000 But then the question is, what do you credit? Now we're estimating that we won't collect accounts receivable, but we don't know which ones, and we don't know for sure the exact amount. So in accounting, we create a new account, what we call a contra account, that goes with the accounts receivable, but goes in as a reduction to reduce it from the $90,000 that they owe to the $85,000 that they think they will get. So the adjusting entry is a debit to bad debt expense for $5,000 and a credit to the allowance for doubtful accounts for $5,000. The bad debt expense will go on the income statement, match the expense with the revenue, and the allowance for doubtful accounts is reported as a reduction in accounts receivable, so that the customer or the decision maker can see that the receivables really are $90,000, but that the ice cream stores think that they will not collect $5,000, which leaves a net realizable value of $85,000. So you have learned in this video how basically accounts receivable are reported. They're reported at the total amount, but bad debt expenses are estimated. They are recognized, or that estimation is recognized, in the same period as the revenue. Why? Because U.S. GAAP says you follow the matching principle. You recognize the expense in the same period as the revenue. So the debit to bad debt expense recognizes the matching principle. The credit, the reduction, is not to accounts receivable because you don't yet know who is going to be bad, which accounts will prove to be uncollectible. Instead, you recognize a credit to the allowance for doubtful accounts. When you report the account, you show accounts receivable $90,000, you show the allowance for $5,000, and the amount then that's actually being reported is the $85,000. And what does that $85,000 represent? It represents the net realizable value, the amount the company thinks they will collect. Why do we do it that way? Because that's the structure of financial accounting. That's the system that we have developed. And whether you're in Boulder, Colorado, or Austin, Texas, whether you're in Portland, Maine, or Portland, Oregon, that's how accounting in the United States is done for accounts receivable. So if you pick up a balance sheet, or if you pick up an income statement, and you see bad debts, or you see the allowance for doubtful accounts, you will know how those numbers were derived. It's that information and understanding how it is created that allows you to be a good decision maker. This is accounts receivable. This is our first account that we've looked at in depth. Have a great day. Take care of yourself.